Well, hello, everyone, and welcome. I'm Tom Steinley, Director of Business Development at Lear Investment Management. I'm joined today, as we are each month, by our host, Jim Warner, who is Head of Research and Co-Portfolio Manager at Lear. We hope you're enjoying your summer, and we'd like to thank you for taking the time to join us for our August market update and strategy webinar. As a reminder, we encourage you to ask questions, and the best way to ask questions is by using the Q&A box at the bottom of your Zoom screen. The objective of these monthly webinars is for us to share our thoughts on the market and our economic outlook, and more importantly, provide some insight into our investment process, which is driven by our proprietary research. These monthly updates give us an opportunity to communicate what's in the portfolio, what changes are being made, and why. Specifically, you'll hear from Jim today about a couple of names we're removing from the portfolio for very different reasons, as well as why we're increasing exposure to a few other positions. In a concentrated portfolio of only 30 high conviction securities, we believe that this level of transparency is imperative and, frankly, a key differentiator. So without further delay, Jim, welcome, and thanks for being with us.
Great. Thanks, Tom. And thank you to everyone who has joined us today. So another month has gone by, and hopefully you guys are having a wonderful summer. It seems like my summer is ending here pretty quickly, and we'll be, as soon as we'll be in the fall, and hopefully, yeah, like Tom said, our weather will break for cooler temperatures. But in the meantime, we've had some very interesting things going on in the market. As you all know, we've had this big rip in the market during June and July. And part of it has been this realization that we may be having an economic soft landing, and that we aren't going to have this recession that has been probably the most forecasted recession in the history of financial markets. And what we think that this means is that this could have improved market breadth. And so we've entitled this presentation as such, that a soft landing equals improved market breadth. So to start with our kind of quick take on the overall economy and the market, as I mentioned, the market is really rallying because obviously inflation is falling. That's an important first step. And then we're seeing better economic data than feared. And that's really taking recession off the table, or at least pushing it out into sometime in 2024. And on top of that, of course, the Fed is close to being done. And so what the market has been doing is taking these pieces and now pricing in a soft landing for the economy. And that's really what's been driving a lot of the move that we've seen in June and July. And a soft landing then means, or should mean, that cyclicals could play catch up to technology. And we've talked a lot about how technology has been really the driving force in the markets, and it's left a lot of the other names behind. And we'll talk a little bit more about that. And we call that market breadth. And so the idea here is that we could see some of the non-technology names really start to play catch up. And as you know, we're going through earnings season right now. And I think a lot of what we're seeing from businesses is very solid earnings across the board, even in the more cyclical names. And so the fundamentals are supporting this thesis of those names catching up in the back half of this year. We would not be surprised if we get a pullback, though, between now and next month. We obviously are seeing a bit of a pullback already in August. That's normal whenever you have a big rip for a couple of months. It's very normal for people to take profits. It's very normal for them to shut down their books and before they go to the beach in August. It's very normal, and but we welcome any sort of pullback. And if you had the opportunity to read my analysis in our newsletter from last month, one of the things that we talked about was an analysis of how material pullbacks of 5% are very common in bull markets. And so we look forward to a pullback of that magnitude because it'll allow us to deploy more risk. And I think from there, though, once we have that pullback, the market trend is still up as it climbs this wall of worry. And so as this rally continues, you can tell from the charts here on the S&P, the NASDAQ, and the Dow that we've had a really nice run of it. And the real question has been, will the Dow start to play catch up? The Dow, as you know, has many more cyclicals in it. And so when you look at the comparison of year-to-date returns with the tech-heavy NASDAQ up over 30%, and the Dow is just up 8%, with its more cyclical components, that's really what we're talking about. Is we're going to see sort of a, under a relative outperformance of the Dow versus the NASDAQ. Now, what's driving this, and as I mentioned, is that the recession that everybody's been talking about has apparently been delayed. And what I've shown here, there's 2 points I want to make on this slide. And the first point is, if you look at the bars, the blue bars here, this is the historical GDP, real GDP growth that we've experienced. And then the forecast is that from the Conference Board. And you can see here that the Conference Board is predicting 1.3% growth this quarter, and then negative 1% in the fourth quarter and negative 0.8% in the first quarter of next year, which basically says they think there's a recession right around the corner. But contrast that with, and by the way, they have been thinking that a recession is right around the corner now for well over a year. And if we showed you the same chart with their estimates going back over the course of the last year, you would have just seen that they've just moved their negative projections out a quarter, quarter after quarter. Now, the other interesting juxtaposition is to put it next to this data point next to that of the Atlanta Fed, which has a real-time forecast called GDP Now that anybody could access. And what they're essentially trying to do is take real-time economic data, throw it into a model, and have it spit out what they expect this current quarter's GDP to come out at. And right now, they expect that this quarter GDP will grow as much as 4.1%, which is a remarkable acceleration in the face of what has been kind of over the last few months, the expectation that we were headed into a recession. So we've got a very maybe different outcome than what the market was expecting, and that's what's driving this better outcome for the economy, is what's driving these markets higher for now. And if you remember back to the Greenspan days, when we talked about Goldilocks economies, where we had really low inflation and really good GDP growth, we are kind of effectively in that right now. As you know, we like to look at real-time inflation that's produced by a company called Trueflation. They look at 10 million real-time data points in the market across services, goods, et cetera. And we just think this is a much better methodology than the antiquated telephonic methodology that the Fed uses. But nevertheless, what this real-time inflation gauge is telling us is that we're back to, in the kind of 2.5% range for inflation, which is normal, which is terrific, frankly. We also know that on the top right graph here that the labor market remains incredibly strong with, near record low unemployment rate, which is propelling down the lower left here, personal consumption expenditures or consumer spending to continue to grow. And that's propelling the services part of the economy, which is still in growth mode. And so, from this perspective, there's a lot of good underpinnings to this economy. And on top of all this, I think this is translating through to the individual consumer. Consumers are, according to at least the University of Michigan survey, are becoming more, excited about the market, or more confident. And certainly part of what's driving this is the strong job market and the declining inflation. We just aren't getting battered by, the shock of higher and higher prices like we were, say, a year ago. I think it's really important to measure where we are from a consumer standpoint versus where we were a year ago, with all the uncertainty on very, very high inflation seemingly hitting us between the eyes every day. Without that, we're actually starting to see the consumer perk up. Now, to get back to this point about market breadth, we saw in July, as the market started to price in more of a soft landing, you started to see the rest of the S&P catch up to the top 7 large cap tech names that have really been driving this market year to date. And while the performance wasn't exactly equal, this is the first time really where we saw the rest of the S&P really rally. Before this, it was really just these large tech names that were driving the market. So we do think that there's a promising opportunity to see kind of cyclicals and which includes energy, financials, start to catch up to the technology names throughout the second half of this year. But that's going to be the big thing that we're going to be focused on. For the visual learners out there, I just put this ratio into graphical terms. And so basically this graph, when it goes up to the right, means that technology is outperforming the rest of the S&P. And you can see that it's basically fully recovered all the relative losses from last year, but it's really starting to peter out. That kind of momentum of moving up and to the right and outperforming non-tech names seems to be indicating that maybe it's sort of topped out from here. And so essentially what we're saying by saying that these names can underperform vis-a-vis the rest of the S&P is, will you see this chart roll over? And that's the question mark that we're examining. And just to sort of recap on what's been working, what's been driving that tech outperformance is, remember, this is the year that the market has really been attracted to large companies with predictable earnings. And the reason for this is because this is the defensive safety trade that investors were putting on to guard against recession risks. Now, it would be logical to suggest that if these recession risks are largely behind us, then these companies that faced underperformance the companies actually benefited from these factors of size and earnings consistency may actually outperform or underperform during the coming months, or stayed in reverse. Cyclical companies which underperformed may outperform. So we think this is kind of going to be a big trend heading into the second half of this year. So from our standpoint, though, from an economic outlook perspective, there's really no change in our view from a month ago. We were never in the camp that we were immediately about to fall into recession. And I think we've made that pretty clear in all of our prior presentations that our view on the market has been that various goods manufacturing type businesses have been going through a rolling set of recessions. Just think about home builders last year, or financials, or energy names last year, or consumer durable goods earlier part of last year. There are a number of parts of this economy that have arguably already entered recession and may even be emerging out of them. It was just the services piece we didn't think was going to break, and was really holding all the pieces together for the rest of the economy. But nevertheless, we have seen continuing signs that the economy is slowing, but not deteriorating. And I think that's the key point to take away today. So, and I think that's been sort of if you will, emphasized during this earnings season that we're finishing up right now. We've seen this robustness with corporate earnings, so much so that we've actually seen the earnings estimates for the S&P 500 increase by 5%. So these are looking out the next 12 months based on what companies have said and the guidance that they provided for their outlooks, earnings outlooks. You've actually seen earnings estimates increase. And so that's actually the first time we've seen that in a while. And that's a good sign that either expectations got too low or things just aren't as bad as people feared. But either way, that's a positive sign. I would note that it is the case that right before any recession, the economy looks about as robust as it's ever been. But at this point, there's just really no evidence that we're seeing deterioration. And I'd continue to focus on the services part of the economy, which still looks pretty darn strong. So with the Fed likely on pause, where we're turning our attention in terms of where the economy is going during the next 12 months is, have we seen the full impact of higher interest rates? We can obviously think about things like mortgages and auto sales and those sorts of things that have clearly been impacted by higher interest rates already. But this is more thinking about the second derivative or third derivative effects of higher interest rates on what does this mean for business investment spending and that sort of thing. And it's unknowable right now. But on the positive side, we're on the lookout for what I'll call green shoots, to harken back to a term we all learned about in 2008 and 9, where these sectors that I mentioned that have already been in recession, are they starting to see a recovery? And to some extent, you could see that in home builders, for example, where things couldn't have been any worse last year. You're starting to see good signs coming out of that sector. So those I think are interesting places to start looking for sectors that are on the recovery and that have been obviously very hard hit over the last year. So, our takeaway is that while there are pockets of weakness in this economy, they've yet to spread into services. And, I think there are also, I'd add to that, that there are also places where you're starting to see recovery. So how does that really impact us from a positioning standpoint? And that's why everybody listens to this call. And I think I think it should be abundantly clear that from looking at a second half standpoint, given the enormous outperformance by technology versus the rest of the market, we do believe that there will be some form of mean reversion. If you look at tech valuations, they've gotten a bit extended. A lot of those stocks have gotten very, very crowded. Everybody's piled into the NVIDIAs of the world, for example. And meanwhile, if you look at the other part of the sort of the overlooked part of the market, there's a lot of value, and we find an enormous number of opportunities there. And so we think that at some point the market will return to looking for really good value and possibly some additional cyclicality to add to their portfolios. We certainly are. The other thing we expect is continued reduction in interest rate volatility with the Fed near its peak. And I think that probably presents a very nice background for fixed income to do better. If you really take a look at what's happened to the US aggregate bond index, it's been pretty unimpressive this year. It's only up 1.2%. Part of this has to do with the fact that it's taken a little while for the long end of the curve for those rates to increase to really match what the Fed has been telling everyone, which is that they're going to raise rates, and then when we stop, we're going to keep them there for a while. Well, the market had a hard time believing that for quite some time, and it has been adjusting to that, and that's been a headwind for fixed income. But I think with the Fed basically done, the market having adjusted to those comments, and interest rate volatility broadly, lowering over the course of the next few months, that should be a pretty good environment for fixed income. I think when we step back and look at our investment themes, and I'm about to talk directly to those on the next slide, we think they're going to do really well relative to the market. So whatever the market does, we feel very, very strongly about the investment themes that we're in. We think they have great secular tailwinds to them, and so we look forward to those things playing out. I'll quickly address before I move on the Fitch's downgrade of U.S. debt. Because it's certainly a question that we've gotten from both advisors and clients, and basically over the short run, it means essentially nothing. It's had no impact on demand for treasuries, and there's a ton of treasury issuance going on right now. In fact, there's about $1 trillion that's being issued over the last combination. It started a few weeks ago, and will continue throughout the fall. That's a lot of issuance. There doesn't appear to be any lack of demand for it. Longer term, however, it's a big problem, and I think it's about time that Washington wakes up to that. Ultimately, what does having too much debt, particularly relative to GDP, mean? Well, it obviously means higher maintenance. So that means that more of the budget is going to need to go towards servicing that debt. That could lead to higher taxes. That could lead to lower fiscal spending on other things. Doesn't matter what the ultimate answer is. It ultimately means that it's going to be a drag on the economy. And so, this is a concern that I think will probably come to fruition, over the coming 5 to 10 years. It's not a today issue, but it's certainly something that people should keep on their radar screen longer term. So let's talk directly to the portfolio. Now, this image is basically a snapshot of our global vigilance model, which is our flagship product. It reflects a moderate risk profile. That tends to be what a lot of clients, the bucket that a lot of clients find themselves in. And as you know, we vacillate the equity allocation based on the amount of risk we want to take in the market. And given the big run that we've had in this portfolio over the course of the last 2 months, we have been taking some profits. And specifically, we've been trimming some of our technology names that have really had a great run. I mean, some of the names are up 50% since we put them on, and we just think that that's a time to trim. This is putting us at roughly around 50% equities. However, I would mention that in our fixed income allocation, 15% of the portfolio is in mortgage REITs. And I'm going to talk a little bit, I talked about them last month, but I want to talk a little bit more about the thesis as to why we think they're so exciting. But that definitely gives the portfolio some extra zip that traditional fixed income does not provide. So you can almost even think of them as an equity from that perspective. The non-tech stocks in our portfolio started to perform, which is great. We've been waiting for certain stocks to really get some life in them, and I do think that this is confirms the thesis that we've had, that going into the second half that we're going to see more of these non-tech names that offer tremendous amounts of value will get revisited by investors. So I think that that's a positive sign. Now, we also exited two specific names, one that was in nurse staffing and then our pawn shop name. And I know I've spoken to both of those in the past. And I think this is an interesting moment to just pause, and because this tells you a little bit about how we think. We exited the nurse staffing name not because of what the individual company, any particular challenges the individual company faced. We had, and it has nothing to do with either with the with the overall secular theme. There are absolutely way too few nurses for the aging population and the healthcare demand that's going to create over the next 10 years. That is a fact. The problem that we ran into with this particular position, and it's actually a problem that's impacting all of its peers in the nurse staffing world, is that there has been essentially a bit of collusion by the hospital chains to dramatically pull back the volume of temporary nurses that they're using. And and I use the word collusion knowing that it's a loaded term, but it seems a bit odd that all of the large hospital chains are acting in the same way. And so when you have large customers not fulfilling orders to even meet the needs of their nursing needs, there's something very weird afoot, and we don't want to be a part of it. So we stepped away, moved to the sidelines on that name. Doesn't mean we don't still love the theme. It's just that there are forces at work at this point that are getting in the way of that theme working. And so when those clouds pass, we may re-enter. So that gives you a little sense of how we think about that issue. On the pawn shop side, honestly, things just worked out. It hit our price target, and we looked out to what the street is modeling for 2024, and we just think it's way too high. So that's, for us, a clear signal that it's time to take our chips and walk away. And it's still the company we're involved with. It's still a wonderful company, and there's still great tailwinds to it. But I think expectations have now gotten too high, and it's time to move on and find a better name. We've also been looking at, we've also been adding to the portfolio in the form of adding some cyclicality. And we've been really focused on clean energy and also liquefied natural gas exports. We have another name that we've added to the portfolio that focuses on that, which is, actually got a bit more of a growthy feature to it. But it's, again, an overlooked name that has a tremendous, decade long tailwind behind it. So we're excited about that. We talked last month about our new electrification theme, and we're still honestly trying to find the right way to play it. But we know this for a fact: the electricity grid has to expand a lot more than it currently is in order to meet all of the electrification needs driven by EVs and all sorts of other products that are going to get plugged in over the next decade. And so that's still a really fascinating theme that we're doing a lot of work on. And then lastly, we are still trolling around for cheap cyclicals, so we can get more of that exposure into the portfolio as we head into what we think will be a market that will be receptive to them. So let me just double click down on the agency mortgage REIT positions that we have in the portfolio, because this is a big part of the portfolio, and it's very important that people understand why we're there. These two graphs I took directly from AGNC, which is the largest mortgage REIT that is publicly traded, and we own a pretty significant stake in. The top graph is a comparison between agency mortgage-backed securities. And again, agency mortgage-backed securities are whatever's come out of conforming mortgages through Ginnie and Fannie Mae. Okay, so there's no credit risk. It's guaranteed by the government. And that's an important point and I'll show you why in a second here. The blue line in this top graph is the spread of agency mortgage-backed securities to the underlying benchmark treasuries. And the gray line is similarly the spread of investment grade bond index to treasuries. And as you can see, the mortgage-backed securities generally trade tighter, and part of it is due to this lack of credit risk that's in the agency mortgage-backed securities, and also it tends to be a much more liquid market, so it tends to trade tighter to treasuries until very recently. In fact, now you can see in this top right, in fact, the relative chart down here is maybe even easier to look at, but mortgage-backed securities are now trading 15 bips wider than investment grade, and we've just never really seen that. It's wild what's happening, and some of it is technically driven. Some of it is to do with the fact that the Fed has moved out of that market and is no longer a buyer. Some of it has to do with the banking turmoil and that natural buyers like banks haven't been involved in the market. But these are all technical things that ultimately get resolved. Another thing driving it, for example, was the FDIC selling down their mortgage-backed security portfolio that they inherited from the failures of Silicon Valley Bank and Signature Bank. So there's these technical kind of weird one-off issues that have driven mortgage-backed security spreads wider. And if you look at this particular chart at the bottom, typically mortgage-backed securities trade at 75 basis points tighter than investment grade. So where we sit today is 90 bips wider than normal. Now, the reason why that's important is that is what that ultimately could mean for the tangible book value of AGNC. And this same analysis could be extrapolated to the other mortgage-backed securities that we own. So where we sit today, though, is that as a base case, AGNC's current portfolio produces a 15% economic return, and that supports the 15% dividend yield that we get from that. And that's obviously a terrific boost to the portfolio. But if agency mortgage-backed securities compress and maybe not even get back 90 bips lower to where they've historically been, let's just say 50 basis points. A 50 basis points compression in spread would actually lead to over 25% increase in the tangible common equity of AGNC or of that portfolio, which, by the way, translates to tangible book value. Why does that matter? Because these stocks trade at generally 0.9 to 1.1 times their tangible book value. So in other words, if spreads compress 50 basis points, more than likely, we're going to get a 25% increase in the stock itself. And then on top of that, we'll get the 15% dividend yield. So it's very important to watch what happens to mortgage-backed securities spreads. And it's something that we just think is sort of a loaded trigger, and we're really excited about. So, I think base case, we're going to collect a nice dividend, and best case, we'll see some pretty significant appreciation, which is not bad for a fixed income allocation. So from a overall portfolio positioning standpoint, I mentioned, we would not be surprised if the market pulls back in the short term. It's had a big move. People are going on vacation. They tend to take down their books. And then September tends to be a historically weak period of the year for stocks. So wouldn't be surprised at all if we got a 5% pullback. In fact, we would love it if it did, because we have a lot of dry powder in terms of cash, treasuries, and investment grade bonds that we would deploy into equities as those opportunities appear. So while we're looking to buy these dips on market pullbacks and add to these higher conviction names, we're also, trying to add this additional cyclical component to the portfolio to see if we can capture some of this, what we think will be relative outperformance in the back half of the year. And in light of all of this, we continue to be very excited about the number of stock picking opportunities that we see. And you get this when the market becomes, gets blinders on, which is what it's had for the last 6 months. Just only one of these top 7 tech stocks, and that provides stock pickers like us an opportunity to, really shine in the back half, we hope. So, I'll pretty much close it there, but, the sum total of all this is that we feel like the market performance will broaden as we sort of price in this soft landing scenario, which seems reasonable to us at this point. And that ultimately should portend for a healthier investment environment. So, with that, Tom, let's turn it over for questions.
Yeah, good. Thanks, Jim. As always, that's really interesting and helpful information. I would encourage people that have questions to enter them into the Q&A box down below. There are a couple already there. One of them is, you had mentioned that there's no significant change in your outlook from last month, but given tech valuations and the potential mean reversion with cyclicals, how much are you thinking about reducing technology and what names, if you can share that, are you thinking about, reducing in the portfolio?
Yeah, well, obviously we won't share what we're doing before we do it. That wouldn't be fair to our clients. But I think what we are looking to do is just bank some gains. Even though we've seen some big moves in some of these names, it doesn't mean that we don't longer term like them. But for some of the names that were really basically trades to get us more exposure, you'll likely see them start to come off the books and be replaced. And they may be replaced with more cyclical names. There may also be some opportunities to add technology back. So, precisely where we come out on all this, some of it is dependent on on what we're hearing on earnings calls. But I would sort of gradually think that we would, our overweight stance in technology will be reduced, and you'll start to see other parts of the book increased.
Great, got it. Do you expect gold to rally?
So gold has always been a hedge for us, and a hedge for essentially overall market volatility. I would actually tell you that we've been reducing that hedge because we think that market volatility has been declining, with a bit more assurance as to where the economy is headed. We probably don't need that hedge as much. However, it is strongly correlated to a weaker dollar. And if the Fed finishes raising and the BOE or the ECB needs to continue to tighten, which it appears that they do, then that actually means that we'll probably get a weaker dollar in the future. And so our gold position will actually work pretty well. So suffice to say that we're happy with where it is. It's not a very big part of the portfolio, but we think it provides a nice little hedge against market volatility, and also provides a nice little bet against the dollar, which is probably going to work in the coming months.
Okay, great. While inflation may be trending now at 2.5% to 3%, have prices on goods been locked in? For example, food prices?
Well, I'm not really sure what you mean by locked in, because nothing's really ever locked in. If you mean like the assumption that the prices are low, I mean, food prices in particular are very volatile, and it's driven by the underlying commodities. And so, one thing, for example, we've seen is, chicken prices have basically come back up while egg prices have gone down. You've seen, a variety of trends going on within, the typical basket of groceries that people buy. So, broadly speaking, I mean, we had that. The other thing too you have to figure out is that we had this big shock to the system with the Russian invasion of Ukraine, and then there was a wheat deal, and now there's not a wheat deal. And so that has implications for whether you're sourcing the agriculture from Brazil or from the US versus Ukraine. And so there's a lot of moving pieces when we talk about food. So our view is that they've come down quite a bit, but there's a lot of moving pieces when you look at it on a category by category basis. But what you're seeing in terms of the overall trend down in inflation is that people have just stopped raising prices at, say, restaurants. They've stopped raising prices on apparel. They've stopped raising prices on cars, right? You're starting to see actually deflation there. So what the market is bearing right now is fewer rate hikes, or fewer price hikes. And so broadly speaking, we think that we're probably going to stick around this current level of pricing for now.
Great. Jim, there was one more question, but it had to do with the potential exposure to equities, and I think you answered that in your closing comments. So I think we're good there. That looks to be all the questions, and we're coming up now on close to 12:40 Eastern or 11:40 Central. So I think that'll wrap it up. I just want to close out by thanking everybody for that's on the call for joining us. Thanks for your continued support, and please let us know how we can help you. Reach out to us at any time, and we'll all make sure that you get a copy of the recording of this, as well as Jim's slide deck, which has already been approved and will be sent out within the next day or two. So anyway, have a great rest of the week. Jim, thanks again, and we'll talk to everybody soon.
Great. Thanks, everyone.